Most traders will never admit this out loud, but you felt it yourself. If I'm not winning at least 60 or 70% of my trades, I'm failing. You see 3 losses in a row and immediately think something is broken. Maybe you're not cut out for this. Maybe you need a new strategy. That quiet, desperate belief has destroyed more accounts than bad entries, bad indicators, or bad markets ever will. Here's the brutal truth that will save your trading career. A disciplined trader with a 40% win rate can grow an account steadily for years, while a reckless trader with a 70% win rate can still go broke in a single bad month. That's not theory. That's the mathematical reality of the game you're actually playing. Professionals know this. They've built their entire approach around it. Amateurs fight it with their last breath because their ego demands to be right more than their account demands to be profitable. Let me put 2 traders in front of you, operating in the same market, looking at the same charts, seeing the same signals. Trader A is your classic high win rate hero. He wins 7 out of 10 trades. Screenshots fill his phone. Green candles everywhere. He feels like he's cracked the code. Every morning, he checks his win rate statistics and smiles. His friends think he's a genius, but watch what happens when the market moves against him. There's no real stop loss, just a mental line somewhere. He tells himself, I'll cut it if it breaks that level. It breaks. He hesitates. It's just a shakeout. I'll give it more room. 5 minutes later, he's down 10% on the position. His chest tightens. Another red candle, now 15%. He can't take it. He refuses to book the loss because that would mean admitting he was wrong, and his identity is wrapped up in being right. So he holds. It has to come back. Sometimes it does, reinforcing this dangerous behavior. But when it doesn't, one bad week in a trending market erases 6 months of feeling like a genius. He was picking up pennies in front of a steamroller, and the steamroller finally caught him. Now meet Trader B. She wins only 4 out of 10 trades. Her win rate would make most people quit in shame. She loses more often than she wins, and she knows it going into every single day. But here's the difference. She cuts every loser at exactly 1R. No exceptions. No second chances. No let me give it more room. When her predetermined stop is hit, she's gone. No emotional attachment. No revenge trading. No bargaining with the market. On the flip side, when she's right, she doesn't panic and snatch quick profits at 0.5R just to feel good. She sits on her hands. She lets winners run to plus 3R or more. She rides trends until the market tells her the move is over. She looks wrong more than half the time, yet her equity curve climbs like a staircase. Steady, predictable, boring to watch, beautiful to compound. Same market, same signals, completely different outcomes. The difference isn't that one has secret information or better indicators. The difference is philosophy. Mindset. Math. Trader A's entire identity is built around his batting average. He needs to be right to feel smart. He gets validation from each individual trade. Trader B's identity is built around her profit factor. She needs to make money to feel successful. She gets validation from her monthly statements, not her win rate. Jesse Livermore understood this over a century ago, when markets were just ticker tape and chalk on boards. He watched countless traders with high win rates go bust during his era. They'd pick up small gains for months, feeling invincible, then get steamrolled by a single uncontrolled loss. Meanwhile, Livermore would sit patiently through small losses, waiting for the pivotal point where he could press his advantage. The game is not about being right often, he said. It's about being right big. Professional traders think in risk units, not win rates. They know that direction is always a guess, but risk is a decision. You cannot control whether the market gaps overnight. You cannot control whether some algorithm decides to slam your stop. But you can control exactly how much you're willing to lose on any single idea. You can control your position size. You can control your exit rules. Here's what most traders miss. Your win rate is just one variable in a multivariable equation. It's like judging a basketball player only by field goal percentage while ignoring points per game. A player who shoots 40% but takes high-value shots can outscore a player who shoots 60% on low-value attempts. Trading works exactly the same way, but your brain doesn't want to accept this mathematical reality. Your brain is wired for immediate feedback and validation. It wants the dopamine hit of being right. It craves the feeling of outsmarting the market. Every loss feels like personal failure, even when it's part of a winning system. Every win feels like confirmation of your intelligence, even when it's part of a losing approach. This is why most traders quit profitable strategies after a few losses and chase shiny new systems that feel better. They're optimizing for emotional comfort instead of mathematical expectation. They want to be prophets, not profit makers. You cannot be both. The real enemy isn't the market. The real enemy is sitting between your ears. It's your ego demanding to be right more often than you're wrong. It's your need for external validation. It's your inability to sit through the discomfort while the math plays out over hundreds of trades. Think about your last 20 trades. How many were winners? Now think about your total profit or loss. Do those numbers align with your expectations? Most traders with 60% win rates are shocked to discover they're barely breaking even. Most traders with 40% win rates assume they're doing something wrong and start system hopping. Both groups are missing the point entirely. Professional trading is the art of doing the uncomfortable thing. It's uncomfortable to take a loss quickly because it admits defeat. It's uncomfortable to sit in a winning trade while it retraces, trusting your target instead of your fear. But that discomfort is precisely where the edge lives. You have to stop viewing losing trades as mistakes. A losing trade executed according to your rules is not an error. It's an operating expense. When a retail store buys inventory, that's a business cost. When you take a planned loss, you've simply paid for information that the market isn't going your direction right now. That's it. You paid for data, not a verdict on your intelligence. Here's what's coming. I'm going to tear apart the illusion that more winners equals more profit with actual numbers. You'll see the elementary school math that separates professionals from gamblers. You'll understand why a 40% win rate with 3-1 reward to risk beats almost any high win rate system that risks big to win small. But the real revelation isn't mathematical. It's psychological. Most traders never implement this math even after they understand it. In the next chapter, I'll show you the simple equation that changes everything. Once you plug in real numbers from real scenarios, you'll never ask, was I right? Again, you'll start asking the only question that matters. Did I execute my process? Strip away the indicators, the news, the opinions, the fear, the hope, and the endless chatter about what the market should do. Underneath all of that noise, trading is just arithmetic. Cold, unforgiving arithmetic that doesn't care about your feelings, your predictions, or your need to be right. There is one equation that professionals quietly live by, the mathematical line that separates a legitimate business from elaborate gambling. Expected value equals win rate times average win, minus loss rate times average loss. That's it. Not your gut feeling about Tesla earnings. Not what some guru promised you on Twitter. Not whether you had 3 green days last week or your cousin made money on crypto. Just that elementary school arithmetic. If your expected value is positive, you have a business. If it's negative, you're slowly funding someone else's retirement. Most traders never calculate this number. They trade on emotion, revenge after bad days, or patterns they think they see in the charts. Then they wonder why their account bleeds out, despite knowing the market better than everyone else. You don't know anything until you know your expected value per trade. Let me show you exactly what this looks like with real numbers. Take our disciplined 40% trader from the first chapter. She's accepted that she'll be wrong 60% of the time, and she's completely fine with that reality. Her statistics look like this. Win rate, 40% loss rate, 60% average loss, 1R top loss respected religiously. Average win, plus 3R profits run to predetermined targets. Now plug those numbers into the equation. 0.40 multiplied by 3R gives you 1.2R. 0.60 multiplied by 1R gives you 0.6R. Subtract the second from the first. 1.2R minus 0.6R equals positive 0.6R per trade. What does plus 0.6R per trade actually mean in your account? Run it over 100 trades, a tiny sample size in a real trading career. 100 trades at plus 0.6R, each equals plus 60R total profit. If 1R equals 0.5% of your account, that's 30% growth. If 1R equals 1% of your account, That's 60% growth. No lottery tickets, no doubling down in desperation, no praying for 10 baggers. Just mechanical execution of a simple mathematical edge. 30% might not sound exciting compared to the social media stories about turning 5,000 into 50,000 in a month, but those stories are either outright lies or survivorship bias from traders who got lucky once and will inevitably give it all back. 30% compounded year after year builds generational wealth. Chasing lottery trades builds debt. Now let's examine the flip side, the amateur who needs to be right. This trader wins an impressive 70% of the time. 7 out of 10 trades turn green. His screenshots look amazing. His friends think he's a genius. But watch what happens when we run his numbers through the same cold equation. His statistics tell a different story. Win rate, 70% loss rate, 30% average win, plus 1R he panics and grabs quick profits. Average loss, 4R, he can't admit he's wrong and lets losses run. Let's do the math. 0.70 times 1R equals 0.7R. 0.3 times 4R equals 1.2R. Now subtract. 0.7R minus 1.2R equals negative 0.5R per trade. Negative. Despite winning 70% of the time. Over 100 trades, that's 50R. If 1R represents 1% of his account, he's down 50% despite being right most of the time. High win rate, negative business model. He's slowly bleeding to death while celebrating his victories. This is the mathematical reality that destroys traders. They optimize for the wrong variable. They chase win rates because being right feels good to their ego. They completely ignore the relationship between the size of their wins and the size of their losses. Then they blame algorithms, market makers, or some conspiracy when the inevitable happens. Let me give you a real example. A student came to me a few years back, furious with a breakout strategy he'd been testing. "This setup is trash," he said. "It only wins 38% of the time. I can't trade something that fails almost 2/3 of the time. I need something that hits at least 60%. I asked him to show me the complete data, not just the win rate that was bruising his ego. We looked at his spreadsheet together. The average win was plus 2.8R because the strategy caught genuine trend moves. The average loss was capped at exactly 1R because he had disciplined stop-loss rules. We ran the expected value calculation right there on his laptop. 0.38 times 2.8R equals 1.064R. 0.62 times 1R equals 0.62R. Subtract. 1.064R minus 0.62R equals plus 0.444R per trade. I looked at him and said, "You're about to throw away a money printing machine because it hurts your feelings to be wrong 62% of the time." He was focused on the frequency of wins. I was focused on the quality of wins. He wanted to be right. I wanted him to be profitable. 6 months later, he wasn't driving a Lamborghini or posting motivational quotes on Instagram, but he had grown his account 18% executing that trash setup with mechanical discipline. More importantly, he was sleeping at night because he finally understood that losing 62% of the time was just the overhead cost of running a profitable business. This equation exposes the fundamental flaw in almost every struggling trader's approach. They try to fix negative expectancy by predicting the future more accurately. They study more patterns, buy more indicators, join more signal groups, trying to push their win rate from 40% to 50% to 60%. They're solving the wrong problem. It's infinitely easier to improve your average win or reduce your average loss than it is to predict market direction more accurately. You can decide right now, today, to never lose more than 1R on any trade again. You can decide today to never take profits before your predetermined target. You've just improved your expectancy without needing to predict the market any better than you did yesterday. Think about how a casino operates. The house edge in blackjack is less than 1%. The casino loses almost half the hands it plays. Do you see the pit boss sweating when someone wins a hand? Do you see casino management panic and change the rules after 3 losing hands? Never. They understand the math. They know that over thousands of hands, that tiny edge will grind down the players and transfer money to the house. You need to become the house. Stop thinking like the gambler who needs to win this specific hand. Start thinking like the casino that knows the math will pay out over hundreds of iterations. Here's where amateurs and professionals permanently diverge in their thinking. Amateurs count winners. Professionals count R. An amateur looks at his journal and sees 7 green trades and 3 red trades and feels like a champion. He never calculates that those 7 greens were plus 0.5 R each, while those 3 reds were 5 R each. He's down 11.5 R for the week, but his ego feels fantastic because his win rate is 70%. A professional sees 4 green trades and 6 red trades and doesn't flinch. Those 4 greens were plus 3 R each. Those 6 reds were exactly 1 R each. She's up 6 R for the week. Her win rate is 40%, but her bank account doesn't care about percentages. It only cares about dollars. This shift in perspective changes everything about how you approach trading. Once you understand expected value, you stop asking, "Was I right?" after every trade. You start asking, "Did I execute my process correctly?" You stop feeling like a failure after 3 losses in a row, because you recognize that's completely normal variance within a positive expectancy system. The hardest part isn't the mathematics. The math is elementary school arithmetic. The hardest part is trusting the math when you're in the middle of a losing streak, when you've lost 4 trades in a row, down 4 R, and your brain is screaming that the system is broken and you need to change something immediately. That's when amateurs abandon ship and professionals tighten their grip on the process. Because professionals know that the plus 5 R winner is embedded in the statistical distribution. It has to come, and when it arrives, it will pay for those 4 losses and leave a profit. But only if you don't sabotage the system by changing rules mid-game because you're uncomfortable with normal variance. The equation can only pay you if you're disciplined enough to let it play out over hundreds of trades while your ego screams at you to interfere. And that leads us directly into the next challenge. Once you accept that you don't need to win often, you run into something your brain hates even more than losing money. Boredom. The psychological torture of sitting on your hands while the math does its work. Because sometimes the most profitable trade you can make is no trade at all. Once you accept the math from the previous chapter, a brutal paradox emerges. If a 40% win rate with proper risk management can generate steady profits, and if the arithmetic is so simple a 5th grader could understand it, why do most traders who know this still lose money? The answer isn't that they can't do the math. The answer is that they are allergic to boredom. This is the silent killer of trading careers. Not market crashes. Not algorithmic competition. Not lack of capital. It's the inability to sit in a chair, stare at a screen, and do absolutely nothing for hours at a time while opportunity after opportunity passes by. Amateurs think edge comes from more trades, more screens open, more action. They bring a blue-collar work ethic to the market, where being busy equals being productive. If you're not moving, clicking, or trading, you're not working. They treat trading like a slot machine that must always be spinning to pay out. Every minute without a position feels like wasted time, like opportunity slipping away. Professionals operate with a completely different biological rhythm. They treat trading like sniping. A sniper doesn't fire at everything that moves. A sniper might lie in position for 3 days, waiting for a single perfect alignment of wind, distance, and target. If he fires early, he misses. If he fires late, he misses. Most of his career is spent not pulling the trigger. The shot itself takes less than a second, but it's backed by days of patient preparation. Jesse Livermore understood this over a century ago. He would sit in brokerage offices watching the ticker tape flow through his fingers for hours, sometimes entire days, without placing a single order. Other traders thought he was wasting time. He was hunting. He was waiting for what he called the pivotal point, that specific moment when all conditions aligned, when risk was small and potential reward was massive. He knew that entering before that point was gambling, and entering after it was chasing. Let me show you what this looks like on your screens today. You have a defined setup in your playbook. You need a clear uptrend, a pullback to a key support level, volume drying up during the pullback, then a volume surge confirming buyers are stepping back in. Your stop loss sits just below the support structure. Your target offers at least 3 R to the previous swing high. This is your edge. This is your sniper's effective range. Now you're watching the market at 9:30 am. You see a stock in a beautiful uptrend. It's the hot name of the day. Social media is buzzing. But it hasn't pulled back to your level yet. It's floating 2% above your support zone, drifting in no man's land with no clear structure. The professional looks at this chart and logs it as no trade. He folds his arms and waits. His portfolio is 100% cash. To him, that's not inactivity, that's an active position. He's actively preserving capital for the moment when his edge appears. The amateur looks at the same chart and feels a chemical surge of fear. It's going to run without me. If I don't get in now, I'll miss the move. I'll just take a small starter position. I'll add when it confirms. That sounds reasonable in his head. It's completely irrational in practice. Here's why that early entry is deadly. When you enter before your setup is complete, you've turned a 3R trade into a 1.5R trade. Your stop loss has to be wider because you're not entering at a logical structure point. Your distance to target is shorter because you entered higher. You've mathematically castrated your edge before the trade even begins. But the real damage goes much deeper than one bad trade. Here's the hidden connection to your win rate that destroys most trading careers. Most traders aren't losing because their strategy is broken. They're losing because they take dozens of trades outside their edge, diluting their own statistics with garbage born from boredom. Let's run the brutal math. Your legitimate strategy generates 100 signals per year. You win 40 of them at plus 3R each. You lose 60 at 1R each. Expected value, 43R 60, 1R South plus 60R. A winning system. But you, the human being with a need for stimulation, can't handle the slow periods. Over that same year, you take an additional 30 boredom trades. These have no real edge. They're coin flips at best, usually worse because you're entering at suboptimal moments. Let's be generous and say you win 8 of those 30. Now look at your statistics. You still have your 40 legitimate winners at plus 3R each, plus 120R. You still have your 60 legitimate losers at 1R each, 60R. But now you've added 8 boredom winners at maybe plus 1.5R each, risk reward because of poor entries, plus 12R. And 22 boredom losers at 1.5R each stops due to poor structure, 33R. Your total is now plus 39R instead of plus 60R. You just destroyed 35% of your edge by being unable to sit still. And this assumes you only added 30 off-plan trades. Most amateurs add far more than that. But it gets worse. Instead of 40 winners out of 100 trades, you now have 48 winners out of 130 total trades. Your win rate dropped from 40% to 37%. You look at your year-end statistics and conclude your strategy doesn't work. No, your strategy works fine. You suffocated it with noise. This is why waiting is not doing nothing. Waiting is your active position. When you see a chart that's 90% perfect but missing one key element, and you choose not to click the mouse, you've just made a profitable decision. You've protected your capital, your mental state, and your statistical edge. You need to reframe your definition of productivity. In trading, cash is a position. Standing aside is a position. It takes more discipline, more professional maturity, and more genuine skill to sit on your hands for 3 days than it does to scalp 20 trades in an hour. The market is designed to extract money from the impatient and transfer it to the patient. Every flashing light, every price tick, every breaking news alert is engineered to trigger your dopamine receptors and make you click. Your smartphone buzzes with trade alerts. Social media feeds show other traders posting their wins. CNBC runs urgent headlines about market-moving events. All of it is designed to make you feel like you're missing out if you're not constantly active. Here's a practical framework that changed everything for one of my students. Treat every trading day as if you have exactly 5 bullets for the entire week. High-quality bullets. If you use all 5 on Monday because you were bored, you're done. You sit and watch for the rest of the week. This mental model forces selectivity. It forces you to ask before every potential trade, is this worth one of my bullets? Most traders would dramatically improve their results by trading less, not more. If you took only your absolute best setups, the ones where every condition is perfectly met, where the risk-reward is obvious, where you'd bet serious money, your win rate would probably improve, and your average win would definitely improve. More importantly, you'd stop diluting your edge with mediocre trades. Professional poker players understand this instinctively. They fold 80% of the hands they're dealt. They sit at the table for hours, mucking cards, watching others play. Amateurs think they're not really playing. They call them tight. They call them boring. But when the professional enters a pot, he's entering with a statistical edge. His selectivity is his edge. Your edge doesn't live in your ability to predict the future. Your edge lives in your selectivity. It lives in your ability to say no to good trades so you can say yes to great ones. It lives in what you're willing not to touch. The amateur sees 10 possible trades and takes 8 of them, hoping to catch the winners. The professional sees the same 10 trades, identifies the one that perfectly matches his criteria, and ignores the other 9 without a second thought. Same market, same opportunities, completely different approach to the game. Livermore had a quote that most traders know, but few internalize. It never was my thinking that made the big money for me. It always was my sitting. He wasn't just talking about sitting and winning trades. He was talking about sitting on his hands, refusing to trade, waiting for the market to present him with his specific setup. The sitting was the hardest part. The thinking was easy. The execution was mechanical. The sitting required genuine discipline. The market will always be here tomorrow. The opportunity you think you're missing will come around again in a different stock, a different time frame, a different market condition. But your capital is finite. Your emotional energy is finite. Your statistical edge is fragile. Every time you trade outside your rules, you're spending all 3 on a negative expectancy bet. Professional trading is not about finding more opportunities. It's about having the discipline to ignore everything except your specific opportunity. It's about developing the emotional fortitude to watch the market move without you and feel completely fine about it, because you know you're waiting for your edge. Your edge lives in your selectivity. The moment you understand that waiting is not wasted time, but rather the foundation of your entire statistical advantage, you'll stop sabotaging yourself with boredom trades. You'll start treating no trade as a legitimate and valuable outcome of your analysis. But understanding this intellectually and implementing it emotionally are 2 different battles. And once you've mastered the art of waiting, and you finally do pull the trigger on your perfect setup, you face the next critical question that separates the professionals from the gamblers. Exactly how much should you risk? Because no matter how perfect your setup looks, no matter how disciplined your entry, you're still going to be wrong 60% of the time. The next chapter will show you exactly how to size positions so that even 6 mistakes in a row never kill you, and how professionals use that safety margin to actually increase their returns through pyramiding. Here's a harsh sentence you need to internalize until it becomes part of your operating system. If one trade can ruin you, you're not trading. You're gambling in slow motion, and the house always wins eventually. Most traders obsess over entries. They spend hours analyzing charts, hunting for the perfect pattern, the ideal confirmation. Then they completely ignore the single most important decision in the entire trade: how much to risk. They treat position sizing as an afterthought, something to figure out after they've already decided they want the trade. That approach is backwards, and it's how accounts die. Professionals build their entire process around a different assumption: they will be wrong. Often. Not occasionally. Often. They expect to be wrong 60% of the time and still make money. They design their position size so that being wrong 60% of the time is not just survivable, it's affordable, comfortable, and psychologically manageable. That protection comes from one boring, unglamorous concept that separates the pros from the gamblers: position size. Let me make this concrete with real numbers you can implement today. You must decide on a unit of risk called R. For professionals, 1 R typically equals between 0.5% and 1% of their account equity. Let's say you choose to be disciplined but aggressive, so 1 R equals 1% of your account. Every single trade you take for the rest of your career will be framed in that unit. Your account is $50,000, therefore 1 R equals $500. This means that on any single trade, no matter how perfect the setup looks, no matter how much conviction you have, you cannot lose more than $500. Not $500 unless it looks really good. Not $500 most of the time. That number is carved in stone. Now you find a setup. A stock is breaking out at $100 per share. You analyze the chart structure and determine that your stop loss needs to sit at $95 based on the previous swing low. That's a $5 risk per share. Here's where amateurs get it catastrophically wrong. They calculate how many shares they can buy with their buying power and hit the buy button. If they buy 500 shares with their $50,000 account and the stock drops to their stop, they lose 2,500, 5% of their account on one trade. The professional does the math differently. He takes his maximum allowable risk of $500 and divides it by the risk per share of $5. The result is 100 shares. That's his position size, period. He buys exactly 100 shares. If the stock hits his stop at $95, he loses exactly $500, or 1% of his account. The market doesn't care how confident he feels about the trade. His position size is determined by math, not emotion. Now let's project this disciplined sizing over 100 trades using your 40% win rate system. You're going to lose 60 trades. That's the statistical reality. Each loser costs you exactly 1 R. That's a total loss of 60 R, or $30,000. That sounds devastating until you look at the other side of the equation. You're going to win 40 trades. Because you're disciplined enough to let winners run to predetermined targets, each winner delivers plus 3 R. That's a total gain of 120 R, or $60,000. Net result, plus 120 R minus 60 R equals plus 60 R, or plus $30,000 profit. Your account grows from $50,000 to $80,000, a 60% return while being wrong the majority of the time, and without ever risking more than 1% on a single idea. No lottery tickets. No prayers. Just mechanical execution of proper position sizing within a positive expectancy system. But here's where most traders destroy themselves. They understand this math intellectually, then completely ignore it emotionally. Let me show you 2 traders with the exact same 40% winning system to illustrate why position sizing matters more than strategy. Trader X is impatient. He wants to speed things up by risking 5% per trade. 10 trades into his journey, he hits 6 consecutive losses, a completely normal statistical occurrence with a 40% win rate system. 6 losses at 5% each equals a 30% drawdown. His $50,000 account is now $35,000. He's lost $15,000 in what feels like minutes. Stop and think about what that does to a human being. His confidence is shattered. He starts questioning the system. He's thinking about revenge trading, about doubling down to make it back quickly. His psychology is in ruins. When the inevitable winners arrive, he's either too scared to take them, or he oversizes them in desperation. He has a mathematically sound system, but he sized it suicidally. Now meet Trader Y. She uses the exact same system and hits the exact same 6-loss streak, but she risks 0.75% per trade. 6 losses at 0.75% each equals a 4.5% drawdown. Her $50,000 account drops to $47,750. She's annoyed and frustrated, but she's completely functional. She can still think clearly. She can still execute her next trade with discipline. When those 40 winners eventually arrive, which they mathematically must, she's still in the game to capture them. Same system, same market, same losing streak, completely different outcomes. The only variable is position size. This reveals the hidden truth about professional trading. Position sizing isn't just about survival, it's about psychology. When you risk 1% per trade, losing doesn't hurt enough to make you emotional. You can take the loss, log it in your journal, and move on to the next trade with a clear head. When you risk 5 or 10% per trade, every loss becomes a gut punch that triggers your fight or flight response. You stop executing your system and start making emotional decisions. Think of it like playing poker where you have to show your cards before betting. Every other player can see exactly what you're holding. Would you go all in on a pair of 10s? Of course not, even though 10s might win the hand. You'd bet an amount appropriate for the uncertainty of the outcome. Trading works exactly the same way, except you're always playing with your cards face up. The market can see your stop loss. Algorithms know your entry point. You have no hidden information. So why would you ever bet an amount that could cripple you if this one hand doesn't work out? The professional answer is simple. You wouldn't. You bet small on every hand, knowing that over hundreds of hands, the math will pay you. You're not trying to get rich on this specific trade. You're trying to stay in the game long enough to get rich over the next 100 trades. Your edge is completely meaningless if your position sizing is suicidal. You can have a positive expectancy system that wins 40% of the time at 3-to-1 reward to risk and still go broke if you risk too much per trade. The math doesn't care about your confidence level. The math only cares about your survival. Here's a mental model that helps. Imagine writing this sentence on a note and taping it to your monitor. The market is about to teach me something I don't know yet. That forces humility. You don't know what's about to happen. You have an edge that works 40% of the time over large samples. But this specific trade, you have no idea. The market might gap overnight. A company might announce unexpected news. An algorithm might slam your stop for reasons you can't see. Your confidence is irrelevant. Your position size is everything. Once you've mastered this survival mechanism, once you've proven you can be wrong 60% of the time and still compound capital, you're ready for the offensive weapon that separates consistently profitable traders from those who merely survive. You've built the fortress that protects your capital. Now it's time to learn how professionals use that safety margin to occasionally turn a planned plus 3R winner into a 5R, plus 6R, or even plus 10R winner without ever increasing their maximum risk. That technique is called pyramiding, and it's the exact opposite of what amateurs do. While amateurs average down into losing positions, professionals add to positions that are already proving them right. They build larger exposure only when the market is paying them, never when they're desperate to avoid being wrong. But you only earn the right to pyramid after you've proven you can survive, and survival starts with never risking more than you can afford to lose on any single trade. You understand the math now. You've accepted that winning only 40% of the time can build wealth if you manage risk properly. You've mastered the sniper's patience of waiting for your exact setup instead of firing at every moving target. You've learned to size positions so that being wrong 60% of the time is survivable, even expected. Now here's where professionals quietly separate themselves from everyone else who knows those same concepts. They add to strength, not weakness. This is the offensive weapon that transforms a merely profitable trader into a consistently wealthy one. But you only earn the right to use this technique after you've proven you can survive the fundamentals. Most traders never reach this point because they destroy their accounts before mastering basic position sizing. The ones who do get here often use pyramiding backwards and blow themselves up anyway. Let me show you exactly what amateurs do and why it's financial suicide disguised as mathematical logic. Their trade goes against them. Price drops below their entry. They're underwater and uncomfortable. They look at their position and think, it's cheaper now. I can buy more shares and lower my average cost. When it bounces back, I'll break even faster. So they double down, sometimes triple down, throwing good money after bad. Sometimes this works. The stock bounces. They break even or make a small profit, and they feel like geniuses. They've just been rewarded for terrible behavior, which makes them more likely to repeat it. But here's the mathematical reality. When you average down, you're adding to a position that the market has already told you is wrong. You're increasing your exposure at the exact moment your thesis is being invalidated. You're turning a manageable 1R loss into a potential 3R, 4R, or catastrophic 5R loss. When the stock doesn't bounce, and eventually it won't, the account doesn't just take a normal hit. It gets gutted. I've watched traders with years of experience, traders who understood risk management, completely destroyed by averaging down into one position that kept falling. They knew better intellectually, but the psychological pain of admitting they were wrong was too intense. They kept throwing money at a losing idea, hoping the market would eventually validate them. It never did. Professionals do the exact opposite. They pyramid up. They add to positions only when the market is already proving them right. They build size when they're winning, never when they're desperate to avoid being wrong. Here's exactly how the mechanics work, with real numbers you can implement immediately. You find your perfect setup. A stock breaks out at $100 per share. Your stop loss sits at $95 based on clear structural support. You're targeting $115 to $120 based on the next resistance zone. You risk 1R on this trade, which equals $500 if you have a $50,000 account. Since your risk per share is $100 entry minus $95 stop, you buy exactly 100 shares. The trade moves in your favor. Price climbs to $105 and then consolidates tightly for several hours, or even a full day. You're watching volume during this consolidation. It's drying up, which tells you sellers are exhausted. The price isn't giving back much ground. It's holding near the highs, coiling for the next move. This is what professionals call a continuation pattern. The market is catching its breath before the next leg higher. An amateur looks at this consolidation and thinks, I should have bought more at $100. I missed my chance to really capitalize. A professional sees an opportunity to add to a winning position, but only under one non-negotiable condition. He can only pyramid if he can trail his stop loss on the entire position to actually reduce his total risk. Here's the critical calculation that most traders completely miss. Your original position is 100 shares bought at $100 with a stop at $95. That's $500 of risk, or 1R. Now price is consolidating around $105. You want to add another 50 shares at a $105. But here's the key move that makes this professional instead of reckless. You simultaneously trail your stop on the original 100 shares from $95 up to $101. Let's calculate the new risk profile. Original 100 shares, entry at $100, new stop at $101. If stopped out, you make $1 per share profit, or $100 total gain. New 50 shares, entry at $105, stop at $101. If stopped out, you lose $4 per share, or $200 total loss. Net worst case scenario, $200 loss minus $100 gain equals $100 total risk, or 0.2R. Read that again carefully. You started with 1R of risk on 100 shares. You added 50 shares, increasing your exposure by 50%. But your total risk on the entire 150 share position actually decreased from $500 to $100. You built a bigger position with less risk than you started with. If the trade hits your stops, you lose less than your original risk. But if it continues to your target at $115, you're now making money on 150 shares instead of 100. Your planned plus 3R winner just became a potential plus 4.5R winner, and you did it while actually reducing your maximum risk. This is the mathematical magic of professional pyramiding. You're only adding when the market confirms your thesis. You're only adding when you can protect the gains you've already made. You're building size when you're right, never when you're wrong. The market is literally paying you to increase your exposure. Now connect this back to your 40% win rate system. Over 100 trades, you win 40 and lose 60. Without pyramiding, those 40 winners average plus 3R each for a total of plus 120R. Your 60 losers cost 1R each for a total of 60R. Net profit, plus 60R. Now add intelligent pyramiding to just 10 of those 40 winners. The cleanest trends where the market gives you perfect continuation patterns. Those 10 trades that would have been plus 3R each now become plus 5R each through pyramiding. That's an extra plus 20R of profit. Your total jumps from plus 60R to plus 80R. You've increased your returns by 33% without taking any additional risk. In fact, you've often reduced risk on those specific trades through proper stop management. Your average win just crept from plus 3R to plus 3.5R. Your expectancy improved from plus 0.6R per trade to plus 0.8R per trade. Your equity curve smoothed out because those occasional big winners now carry more weight. And you accomplished all of this by letting your winners do the heavy lifting, not by trying to be right more often. This requires a massive psychological shift that most traders never make. You must fight every consumer instinct you've developed over a lifetime. In the supermarket, you buy when prices drop. That's called getting a bargain. In the stock market, you buy when prices rise. That's called following strength. You must train yourself to feel comfortable buying higher prices, because price movement is information, and rising prices tell you that buyers are more aggressive than sellers. You also must resist the overwhelming urge to ring the register the moment you see green on your screen. The amateur sees his $500 profit at $105 and thinks, I should lock this in before it disappears. The professional sees that same $500 profit as evidence that his thesis is working and considers how to responsibly increase his bet size. Think about how a professional poker player operates. When he's dealt a mediocre hand, he bets small or folds. When he's dealt a strong hand, and the community cards confirm it, he increases his bet size. He's not betting the same amount, regardless of how the hand develops. He's scaling his exposure based on how much the evidence moves in his favor. Trading works identically. Your initial entry is your small bet with incomplete information. You're not sure yet if this trade will work, so you size it for survival. As the trade develops and proves you right, you scale up your bet. You're adding chips to the pot only after you've seen more evidence that confirms your thesis. The amateur goes all in on incomplete information and prays. The professional builds his bet as the evidence accumulates in his favor. Here are the non-negotiable rules that keep pyramiding safe instead of suicidal. First, only add after price has moved far enough in your favor to justify tightening the stop on your entire position. If you can't reduce total risk, don't add. Second, only add at logical structural points, breakouts from consolidations, successful retests of support, or fresh momentum in your direction. Never add randomly just because you're up money. Third, never add to a trade that's still near break-even or underwater. That's averaging down wearing a disguise, and it will eventually destroy you. Fourth, any additional size must come with a tighter stop such that your total account risk never exceeds your original planned loss. This is the mathematical foundation that makes pyramiding safe. Fifth, have a predetermined plan for pyramiding before you enter the trade. Don't make emotional decisions in real time when money is moving. Follow these rules religiously, and pyramiding becomes a way to responsibly press your advantage when the market hands you a gift. Ignore any of these rules, and pyramiding turns into emotional overexposure that will eventually bankrupt you. Your equity curve begins reflecting something that most traders never internalize. You don't need to be right more often to build serious wealth. You need to be paid more when you are right. A trader who wins 40% of the time but occasionally pyramids into strong trends can dramatically outperform a trader who wins 60% of the time but never scales into strength. Let me give you the maxims that should guide every decision from this point forward. Cut losses fast. No exceptions, no second chances, no hoping it comes back. Size small initially. Every trade starts as a survival bet, not a lottery ticket. Wait for your exact level. Boredom trades destroy mathematical edges faster than market crashes. Add only to strength. Build size when the market pays you, never when you're underwater. Let the math, not your ego, define success. You're running a business, not proving you're smart. You came here asking how 40% could possibly be enough. Now you understand the complete answer. It's enough because everything that actually matters in trading, your risk per trade, your position size, your exit discipline, your patience, your ability to pyramid into winners, is completely under your control. Everything your ego obsesses over, being right, predicting the future, outsmarting algorithms, is not under your control and doesn't determine your profitability anyway. The market doesn't care about your win rate. Your bank account doesn't care about your win rate. The only thing that cares about your win rate is your ego, and your ego is the most expensive liability in your entire trading operation. Everything your ego loves, being right, looking smart, having opinions about market direction, is irrelevant to building wealth. Everything your ego hates, taking small losses, sitting still, buying higher prices, admitting uncertainty, is exactly what fills your account. If you can separate your self-worth from your win rate and focus entirely on process over outcomes, you become dangerous in the best possible way. You become the trader who can lose 6 times in a row without flinching, then ride the 7th trade to a massive payout that covers all the losses and funds your lifestyle for months. The math is elementary school arithmetic. The psychology is graduate-level difficulty. The hardest part isn't calculating position size or trailing stops. The hardest part is maintaining emotional equilibrium when you execute everything perfectly and the market still stops you out 4 times in a row. How do you pull the trigger on the 5th trade without hesitation? That's the final frontier between knowing these concepts and living them profitably. If this series has fundamentally reset your understanding of what actually drives trading profits, the next lesson will show you exactly how professionals protect their psychology during inevitable losing streaks. Because the most mathematically sound system in the world becomes worthless if the operator's mindset breaks down before the edge has time to play out.